You check your bank account on a Tuesday morning. Not because something happened. Just habit. The number looks the same as it did last week. Maybe a little lower. You tell yourself it's fine. You tell yourself you're being responsible. You have a job. You pay your bills on time. You even have a savings account, one of those high-yield ones you read about in an article somewhere. And yet, something feels off. Like you're doing everything right, but the math never quite works out the way it should. Like there's a version of financial life that other people are living, and nobody ever handed you the instructions. You're not wrong about that feeling. There are instructions. You just weren't given them. Think about what a normal Tuesday looks like for you. You wake up. You go to work. You get paid, let's say $4,200 a month after taxes. That's $50,400 a year. Decent. Not rich, but decent. You pay $1,400 in rent. $480 for your car payment and insurance. $300 in groceries. $150 in subscriptions you haven't audited in 2 years. Utilities, gas, phone, another $280. Maybe you put $200 into savings if it was a good month. The rest disappears somewhere you can't fully explain. You've done the budget. You've downloaded the apps. You've watched the videos about cutting lattes and cooking at home. And some of it helped. But the fundamental situation didn't change. The number at the end of the month still feels like a ceiling you can't push through. Because budgeting isn't the system. It's just inventory management. And you can't get wealthy by managing what you already have. Here's what nobody explained to you in school, in your first job, or in any of those personal finance articles written by people who somehow turned a $500 investment into a beach house. Money isn't a thing. It's a relationship. And like every relationship, it has rules. Unspoken ones. Rules that the people who designed the system already know, and the people inside the system are just now beginning to see. You were taught that money is something you earn. You trade your time for it. Your employer decides what your time is worth. You get a number on a contract, and that number becomes the ceiling of your entire financial reality. Everything you build, everything you save, everything you invest, it all starts from that number. Someone else's decision about your value. That's the first rule of the system. Most people spend their entire lives inside a box that someone else drew. And it's not evil. It's just design. The economy needs workers. Workers need wages. Wages create consumers. Consumers create demand. Demand creates profit. Profit flows back to the people who own the structure. Not the people who show up inside it every morning. You show up inside it. You were trained for it from age 6. Sit down. Follow instructions. Raise your hand. Wait for permission. Get graded. Get certified. Get hired. Get paid. The whole sequence is a pipeline, quietly engineered to produce reliable participants in the machine. And the machine is not broken. That's the part most people miss. The machine is working exactly as designed. The confusion only comes when you assume the machine was designed to serve you. It wasn't. It was designed to run. You are fuel. But something shifts. For some people, at some point, the picture changes. Maybe it starts with a single number that unsettles you. You learn that the S&P 500 has averaged roughly 10% annual returns over the last century. You do the math. If you invested $500 a month starting at 25, by 65 you'd have over $3.1 million. Not because you were a genius. Not because you caught a lucky break. Simply because you understood how compounding works and you started early enough for it to matter. Then you look at how many Americans have less than $1,000 in savings. And something clicks. The information was never hidden. It was available the whole time. In books. In libraries. Online. Everywhere. But most people never went looking. Because nobody told them the search was worth making. That's the first disruption. The game isn't rigged because the information is locked away. It's rigged because most people don't know the game exists. Level 1 is where most people live their entire lives. You earn. You spend. You save what's left, which is usually nothing. You think of money as a resource that gets used up. You believe your financial ceiling is your salary. You assume wealth is something that happens to other people, luckier people, people who started with advantages you didn't have. Some of that is real. Starting conditions matter. Advantages are real. But level 1 isn't just a financial position. It's a mental model. And the mental model is the actual trap. In level 1, the thought is simple. I need to earn more money. So you work more hours. You pick up freelance gigs. You get a second job. You push harder. And sometimes your income climbs, let's say from $50,000 to $70,000. And for a moment, things genuinely feel different. Then lifestyle creeps in. The apartment upgrade. The newer car. The vacation you felt you deserved because you worked that hard. And somehow, within a year, you're back to the same feeling. Same ceiling. Just a different number underneath it. This is called the hedonic treadmill. And it is one of the machine's most efficient features. The system doesn't need to keep you poor. It just needs to keep you spending. Level 2 begins with a question nobody ever asked you before. Not how do I earn more? But how does money actually move? Because money doesn't sit still. It's always in motion. Flowing into things that produce more of it, or away from them. And once you start watching the movement instead of just counting the amount, everything you thought you understood starts to look different. You learn what an asset actually is. Not a house, necessarily. Not a car. An asset is something that puts money into your pocket whether you show up or not. A rental property. A dividend-paying stock. A business that doesn't require you to be there every day. A piece of content or intellectual property that earns without your involvement. A liability is something that takes money out. Your car payment. Your credit card balance. The things you call assets because they have a number attached to them, without accounting for what they cost you every single month. Most people's entire financial lives are quietly built on liabilities they've convinced themselves are assets. Your car isn't worth $32,000. It costs $32,000, and then it keeps costing. Every month. Depreciation, insurance, maintenance, payments. It is not building your wealth. It is slowly draining it. This is not about judgment. It's about language. The language you use to describe money determines every decision you make with it. And in level 2, you start learning a new vocabulary. Cash flow. Net worth. Return on investment. Passive income. Leverage. These aren't buzzwords for people in suits. They are the operating language of the machine. And people who grow up in wealthy households learn them the way other kids learn to read. Here is where the machine becomes fully visible. There are two economies running at the same time in this country. They exist side by side. Most people only ever see one of them. The first economy is the one you grew up in. You trade time for money. You pay income tax, the highest tax type of money that exists. You buy things. Things lose value. You work more to replace them. Your wealth, if it grows at all, grows slowly. Linearly. 1 hour, $1 at a time. The second economy runs on assets. In the second economy, money makes money. A person who owns $2 million in index funds earns roughly $200,000 a year in average market returns, without working a single additional hour that year. They pay capital gains tax on those earnings, which is taxed at a lower rate than regular income. Sometimes significantly lower. Then they reinvest. And the following year, the same percentage return generates even more, because the base is larger. The gap between those two economies doesn't shrink with effort. It compounds. Every year you remain in the first economy, the distance between you and the second one widens. Not because the system is getting more hostile. Because compounding is directional. It accelerates whatever is already in motion. This is the machine. And it runs whether you understand it or not. Level 3 is where most financial advice stops. Invest in index funds. Max your 401k. Diversify your portfolio. Live below your means. And none of that is wrong. For level 3, it is exactly right. If every American followed that advice consistently, the average person would retire with real security instead of real debt. But level 3 is not the ceiling of the system. It is the entry point to the second economy. Because at some point, if you stay paying attention, something else comes into focus. The people at the highest levels of wealth are not primarily investors. They are owners. They own equity in companies. They own real estate portfolios. They own the systems, the structures, the platforms that other people participate in. They don't just put money into machines, they own the machines. And then they collect a fraction of everything that moves through them. This is not about idolizing billionaires. The point is simpler than that. Ownership is a fundamentally different relationship to money than employment. Not slightly different. Structurally different. And the system is designed in a way that ensures most people never seriously sit with that distinction. Level 4 is where it gets uncomfortable. Because at level 4, you stop seeing the system as neutral. You start to see that the rules weren't written for everyone. They were written by people who already own things, to protect what they owned, and to make challenging that ownership feel unreasonable or irrelevant. Why is capital gains tax lower than income tax? Because the people who shape tax policy own capital. Why do corporations receive deductions for expenses that individual workers don't? Because corporations were architecturally designed to accumulate. Individuals were designed to consume. Why does generational wealth compound faster than earned wealth? Because inherited assets transfer at a stepped-up cost basis. The gains accumulated over an entire lifetime can vanish from a tax perspective the moment they are passed to the next generation. Legally. By design. This is not a theory. It is published tax code. Public record. Available to any person with an internet connection and the willingness to read it. The rules of the game are written down. Most people just don't read them. And the people who wrote them are counting on exactly that. Now you see what the machine actually runs on. Not money. Information asymmetry. Not secret information. Available information. Documented, legally accessible, publicly published information that the majority of people never encounter. Because the educational system wasn't built to teach it, the media landscape wasn't structured to clarify it, and the culture actively discourages you from asking about it directly. Don't talk about money is not just a social rule. It is one of the machine's most effective features. It keeps people financially isolated from each other. You don't know what your coworkers earn. You don't know what your neighbors actually pay in taxes. You don't know your employer's profit margins. You navigate a system you cannot see, using rules you were never taught, competing against people who grew up understanding everything you are only now beginning to learn. And the part that stays with you longest? The information was always free. The IRS publishes tax law. The SEC publishes investment filings. The Federal Reserve publishes economic research. Every major public company's annual financials are accessible documents. The library has never been locked. The machine simply runs on the assumption that you won't go looking. Now step back further. Because money, at its deepest level, is not really about money. It is about time. About what you are no longer forced to do and what you finally become free to choose. It is about who holds leverage when a decision is being made, and who doesn't. About which options appear in front of you and which ones never become visible at all. The person with no savings takes the job they're offered because they need it this week. The person with 2 years of living expenses saved waits for the opportunity that actually fits. That is not luck. That is leverage. Built quietly over time, through decisions that only make sense when you understand what you're constructing. Financial freedom is not a number in an account. It is optionality. It is the ability to say no when something isn't right. To wait when waiting is the smarter move. To take a risk without your survival depending on the outcome. It is living in a world with more doors than the one you were handed at the start. The people who reached that world didn't discover a secret. They changed the question they were asking. Not how do I make more money? But how does money actually work? Not how do I keep up? But what is this system, and what role have I been assigned inside it? Not when will things get easier? But what am I building, and does it keep building when I'm not watching? Once those questions take hold, you can't go back. The machine becomes visible in a way it never was before. You read things differently. You hear conversations differently. You make different decisions, not dramatic ones, not overnight changes. Quiet ones. The way you evaluate a raise. The way you look at a purchase. The way you think about debt, about time, about what you are actually exchanging when you exchange your hours. The shift doesn't feel like motivation. It feels like something settling. Like a lens clicking into focus after years of blur. You are not fired up right now, you are still. Slightly unsettled. Recalculating things you thought were already figured out. Hold that feeling. Because motivation is gone by Thursday. But understanding, real understanding, the kind that quietly rewires how you see everything, that doesn't leave. It just keeps changing what you notice. Somewhere across the city right now, there is a person who is 23 years old. They just received their first real paycheck. They are looking at the number. Feeling proud. Already thinking about what to spend it on. Nobody has sat them down and asked what they know about how money moves. Nobody has explained the two economies, the compounding gap, the cost of waiting, the difference between owning and working. They are about to begin making decisions that will quietly shape the next 40 years of their life, and they are doing it with level 1 information. The machine does not need to stop them. It just needs them to stay busy. Stay spending. Stay inside the box that someone else drew. And somewhere else, a little older now, someone is sitting with a number on a screen. A number that grew last month without them. A number attached to something they own, not something they did. They are not thinking about the 23-year-old across the city. The machine does not require them to. It just keeps running.